5 p.m. in Perth. It's 8 p.m. in Melbourne. And it's too much work out anywhere else on the planet. So I hope you're well. Thank you for popping into this week's Inner Circle session. It's always a pleasure and a privilege to have you along for the ride on this Wednesday evening jaunt into the markets. Of course, we'll have a look at live markets towards the back end of the session and talk a little bit about the sorts of things that are driving markets early on, and then we'll go into obviously we'll looking at some strategies, some practical advice in terms of how to move from having ideas and strategies and trading plans to actual consistency. There's a few practical tips that I've got that might help you along the way. And it's the intention for tonight's session. So remember, it's your session, so please feel free to ask questions and make comments if there's any charts you want us to have a look at as we move to the back end of the session. Very happy to do so. But of course, most importantly for right now, then just remember that this is for educational purposes only. Please make sure you do your own due diligence on anything that you see or hear. And make sure that when you trade managing risk both on profit both on entry and exit. Retaining profit is as important as managing capital loss. Make sure it's all consistent with your personal circumstances and financial situation, please. Okay, thank you to everybody who said hi in the questions box already. As I said, it's always a privilege, and I'm always very grateful that you take the time just to say hello. It's always really appreciated. Good day to Wait, it's 7:30 in Adelaide. Sorry, mate. And good day to Neil and Roger and you and all of you, whether watching live on YouTube or you are playing catch up and watching the recording later. If you wouldn't mind, if you like what you hear, if you wouldn't mind clicking that like button, it's always very appreciated. And of course, make sure you subscribe to the channel so you never miss a show when we're streaming live on YouTube. Just a little bit about what we're going to talk about later on. Markets wobbled a little bit, but the buyers look as though they're back in. Are we up for a Santa Claus rally? Well, the next couple of days may well give us the answer to that. There is key data. It was a shortened week last week. It's not a shortened week this week. And although it feels as though it has been, I've been quite busy. The Fed expectations are very fluid, with maybe PCE data dependent, which is on Friday. Gold strong, crypto bouncing, and of course there's other charts to watch, which we'll have a look at. So we'll do that in around about half an hour's time. So be ready and waiting for that. And as I said, if there's anything you want me to have a look at, then I'm more than happy to cast an eye on a chart or two. So the real benchmark of a successful trader isn't a perfect win rate. It doesn't happen. But we do know from experience that if you have a plan that you've done some work on in terms of creation and refinement, and there's some evidence that it works well for you, then it's consistency and execution, which is key. You can have the best plan on the planet, but if you don't follow it, then A, you can't determine the success of otherwise of that strategy, but B, it's not going to fulfill its potential. The reality is that most traders plateau after the strategy discovery stage. So we all start off getting very enthused about moving average crosses or whatever strategy it is we started off on. And subsequently, there are many people in the markets who, although they've been in the markets for a long time, actually haven't got more than a year's worth of experience because they keep repeating doing the same things year after year after year after year. Whereas you've got some people who've been in the market just 2 or 3 years, and because they're striving to do the right things on a consistent basis, they tend to clock up real meaningful years of experience and start to move towards becoming the trader they can be. Good night, Brian. Good to see you. So there are a few reasons why people plateau. There is the illusion of progress, as I would call it. If we have more indicators and more systems, more things on our charts, more colourfulness, more webinars attended, that doesn't necessarily mean that that's going to make a difference unless you take action on some of the things that you see, some of the things that you measure, and some of the things that you hear. So most traders stay in the realm of same sort of inconsistency in results, despite progress in inverted commas, learning all of this extra stuff and doing all of this extra stuff, which doesn't actually make a difference nor contribute to consistency. When we talk about a gap in consistency, it's possibly worth thinking about here, is it's the difference essentially between knowing what your rules are and making sure that they're specific and unambiguous, so you're, as I said, and refined it, so you've invested the time on making sure that they're okay, and subsequently following them with some discipline. That's the consistency gap that we're talking about, and most people live in that consistency gap. In real terms, what consistency looks like is in performance metrics. So things like equity curve stability, drawdown control, trade frequency, regularity, knowing when to switch things off completely in your world, and we'll talk a little bit about that later on, and when to switch things on, when to put your foot on the accelerator, when to take it off. And so there's lots of things we can do in terms of measuring performance metrics. There's all sorts of nice little scripts and tools that have been on development. The latest one's pretty slick. I've got to show you this. Let's just have a little side thing. You know that we're very enthused about the EAs, and that back testing of them is a indication that they may work in the reality of a live market, although there are obviously limitations to that. So lots and lots of work going on in terms of assessing what back tests are really telling you. And so this is what I came up with today, and I posted it for those of you who are part of it in the relevant place. So what I'm going to do is I'm going to try and find it. This is a file around just before on a back test, which is only 0.2 of a contract over 2 years on the NASDAQ. So this is the new. So what it does is I put some log in that measures every trade during the back test period, and then put lots and lots of fancy pants calculations in the background, and to give us this. So this is over 124 trades in 0.2 of the contract. So really quite nice. Give some key insights, some key issues, and some immediate actions to take, and then gives the key metrics around that. And you can see those metrics are quite good. Average wins $46, average loss is 16. So in terms of the entry quality analysis, it's good. In terms of the exit management, some interesting stats on how long winners were for, how long losers were for. Risk reward ratio is 2.77, which is healthy. 2.21 profit factor is good. And then some market regime performances, so how it performs well in different sorts of markets. You can see there, not perform particularly well in, it is a long trend down, low volatility, surprisingly. And then looking at how it trades in volatile markets, you can see the win rate there is very good, albeit on a inconsequential sample size, but good on this one, 65%. And a little weak when there's large ranges. This is a range-bound breakout model, so it's looking at this metric is looking at the range that it was in before it breached. So if it's over 380R, it's saying win rate's a bit iffy. So all of this is what I mean by key metrics. So we can look at days of the week, times we entered, all of that sort of stuff. So we look here between 1 and 2, and it's not particularly clever, is it? So again, that might be something we'll look at. Now that's the top end of back test and analysis, performance analysis, but we can do that in a much lesser level. Yeah, I thought you might like that. Good night, Michael. But what I was doing by showing you that is not to impress you, but to impress on you the value of measuring performance. Writing scripts like that is a stretch, but it's very possible with discretionary trades as well as automated trades. The difference is that you're doing it on your actual trades taken in your account rather than on a back test. And there's a whole new story there if you want to investigate it at a future stage. So there are three forms of inconsistency. There's what I call execution drift, which is deviate from plan. This can be entry, exits, or both. It's usually the latter. Emotional override, where being in the middle of the heat of the action starts to mess with your decision-making processes. We've talked cognitive biases at length previously. Things like fear of missing out, things like just staying in that trade just to see if it can go up a little bit more, or some hesitation when there's breaking structure. So if it breaks through a support, let's just see if it stays there for another candle. Let's just do another candle. Let's just do another candle. And then the third one is possibly at a more advanced level, what I would term adaptation error, which is failing to adjust to market context shifts. So when we talk about market context, we're really talking about trend situation, trend states. So if you are trading long, as you saw by that backtest analysis of an EA over the last 2 years, it doesn't do particularly well in low volatility downtrends. So that's a great example there of why you may say, right, okay, I'm wanting the nature of low volatility markets is they can flutter quite a lot, and that can be a flutter downwards, but also some people trade them because they think, well, low volatility market eventually it's going to pick up, and then we could be on the receiving end of a really good move in our favor. But equally so, of course, you could be on the receiving end of something that's not in your favor. So things like multi-time frame confirmation or confluence is important. And what happens in reality is traders often add more and more complexity to a strategy. Let's add another indicator. Let's add another indicator. Let's add another 3 or 4 different criteria. And what happens then is it becomes so complex to actually get in that you either miss trades or you just ignore your plan anyway. But there's a reassurance. Well, if I do this, this, and this, at least I'm doing something. I'm not actually doing the hard work, the non-sexy work that is all about the yards of keeping a journal and measuring it and doing some performance analysis on it, which would help reinforce structure that underpins your strategy. But it's that feeling of doing something has got to be better than doing nothing. And so we do the things that, I mean, we can go into a chart. We can say, right, let's add the common things we often see is we will see people adding several things that tell you exactly the same thing. So we'll maybe get a let's see this. Okay, so we'll maybe stick a range on there, and we might stick it's all very well because it helps us see breakouts. But we've got some moving averages on there, two moving averages on there. But let's just double up on it, and let's stick a MACD on that. Okay, and then there we go. We'll stick a MACD on it. We've got an ATR on it to tell us volatility. That's fine. But now let's add an RSI just to see if something's overbought. Because we don't really understand it, let's stick a stochastic on it. And it gets more and more and more colourful without giving you any more information. Whereas what we really need to do is actually look at this bit here. We've got a range that's identified. All we need to know is A, is it likely to breach it? B, if it's likely to breach it, is there anything that's going to stop it? And at this stage, it doesn't look as though there is. Even going back to a 4-hour chart, it looks as if it's got an upside potentially of around about 60 points. And then what we can do is we can sort of say, well, look, on the longer time frame, it is still an uptrend. So that's all very cool. And that's just looking at price, where it sits in market structure. We don't need all this stuff. But that's reassuring. And it's pretty, isn't it? So we do that rather than doing the stuff that's going to make the difference. There isn't a perfect entry. Textbook entries where you get that pattern, the breakout pattern I just showed you, that would be really cool. But there isn't a perfect entry. There's a great entry, There's a high probability entry, but a perfect entry, arguably there isn't one. There's no silver bullet, golden bullet, whatever sort of bullet it is, that is going to mean that you get in at the right time, in the right place, and make consistent profit. There's a perfect trade, but a perfect trade is different than a perfect entry. The perfect trade is one where you're following your plan to the letter, and that plan is based on consistent evidence that it enters and exits well, whether that be in a loss situation or a profitable situation on each individual trade. That's your perfect trade. So if we are looking for process as our primary goal to achieve that consistency that's more likely to produce sustainable results, there are three core pillars. There's a pre-trade routine. I've called it a daily agenda before, which is structured analysis, all what's happening in the markets. That's what I do on the live updates, and pop along tomorrow if you want to on YouTube or on GoToWebinar. The clarity of conditions, so what's happening, not what's happening overall in the market, but what's happening right now. And then there's what I call a readiness check, which is all about you. Are you ready to trade? Have you realigned with your plan? Are you in the right place? You're not going to be interrupted or disrupted. Then execution discipline. So execution discipline is not just about the trigger finger, but also acting without hesitation when your plan says it's time to go. And then, of course, your post-trade reflection, your review, your login, you're extracting learning from every trade if you can. I remember when I first started teaching people, then the mantra of mine then was plan it, trade it, test it. Which hasn't changed in 20 years of doing this. So you plan it all out, then you trade it, and then you test whether it works or not. So it's all about creating, it's not rocket science, this, but there is a discipline. This, if you like, is discipline in systems or discipline in system execution. Not just about your trading plan, but producing these processes that facilitate consistency that you can subsequently easily hook into, and they only take a few minutes, but will serve you well going forward. So not rocket science, it's simple, but it does require you to actually do it. Don't know what I've done with the with some animation here. Apologies for that. Now I've already sort of referenced the importance of testing. So let's just talk feedback loops. So we can measure stuff. I know plenty of people have kept a journal, but don't actually look at it. Don't actually do an analysis of it. Don't actually sort of let's take something really simple. Let's say that you do, let's make the maths easier. Let's say you do 120 trades and you're trading 3 strategies. And each of those strategies, you're trading 40 trades. But what we tend to do is we tend to look at the overall account balance of those 120 trades. That's what we judge. That's what we do our judgment. We don't get any deeper than that. Surely it must be more robust and more wise in terms of let's look at those 3 strategies independently. Let's even look long and short independently. So there's no, with most traders, there's no, right, I'm trading this and trading this and trading this, and these are the things that I'm measuring to make sure that A, I'm doing okay in trading how I should, and B, the system's doing okay in the market. Those are the 2 key questions you try to ask. Without feedback loops, without systemization of that, you're not going to get it. And I showed you the ultimate feedback loop, which is a script that can be run on your account. Yes, I am developing those for discretionary traders. Put me a line if you're interested. So what it would do is it would do exactly the same work on your account and potentially say, hey, look, these are the things that are going well, these are the things that are not going well. If you missed it before, ask me at the end. to show you the latest variation on that. Is this making sense, guys? Is this resonating? Good. But what you need to do is again, it's not rocket science, it's just process again. It's collect, analyze, adjust, apply, repeat. Collect, analyze, adjust, apply, repeat. It's not hard. So we collect the data, we have a look at that and tell what it's going to do. This is all about closing the circle. We adjust our plan accordingly. If we find that if we've taken 30 trades and used a price EMA cross as an exit, and that was at 30, well, it's really easy to stick a 20 EMA on charts that we took trades on and see if it would have been better or not, record them and see which is better. That's our adjustment. Then we change that in our trading plan and repeat it. It's, again, not rocket science, but it's a really important process. Then we need to if we're doing once we've got a critical mass of trades, or we can even convert our strategy into an EA, and even if you don't want to use the EA, it can give you some invaluable feedback on it. So we can look at, we looked at, again, if we look at this feedback here, then we know straight away our win rate is 50-50-ish. But we know that our average win is 3 times our average loss on this one strategy, on this one instrument. That combined with our win rate, if that's consistently delivered, be that discretionary or through an EA, is a recipe for ongoing positive outcomes. But you can only make that decision if you have that information collected. We can only make the decision that maybe we need to stay clear of large ranges. If we take it back to that chart again, so you see ranges can be really large or really quite small. And what that analysis is saying is this really large range that creates our top and bottom of that range is possibly not the best situation to trade. But we can only find that out by doing things that actually sort of enable us to do that, by having the things in place. Thank you, Roger. So I hope that sort of makes sense. It's not just about measuring for measuring's sake. It's got to be a closing of the circle. Once you've got a critical mass of trades, you can look at win rate, you can look at time of day performance, you can look at risk reward ratio trends. So all sorts of weird and wonderful stuff that we can get machines to do for us. So we know straight away that range size impacts us. If we look at time of day, we know that medium volatility is best. We know that this is okay. It doesn't matter whether it's an early entry in a breakout or a later entry, it's still okay. If we look at our morning versus our evening session, look at the difference. 32% win rate in the morning, 59%, 53% in the evening. What does that say? What does that say? What would that, if you saw that, if you had that bit of analysis, what would that say to you? Absolutely. Our average per trade is $15 to 1. Is that worth your time? Or would you better how do you measure this? So you're doing half of the trades. Okay, so more than 50% of your trades give you around about 90% of your profit. Isn't that mad? You're only going to know that if you do some measurement. That's the role of feedback loops. And of course, the other thing is that there's often differences between what we would record in journals and performance analytics, like you've just seen. Why would that be? Well, it's really quite simple. First of all, it takes time to write in a journal. That's all automated, pulling out facts, numbers. Whereas the real benefit of doing a journal is to make notes on what you're seeing as outside of the trade as well as inside of the trade. But we would rarely see people do that. It may be that there's a little bit of maybe you don't get to do it straight away. Maybe some time before you get a chance to do it. So you've got a little bit of maybe you're not remembering everything as it was. Or maybe the opposite is the case. Maybe you're in such a rush to do it that you miss some of the obvious things that are in front of you. So there's lots of things we can do. We've got trade logs that you can get on MT4, MT5, Excel dashboards, journaling templates, and of course then the next level, which is things that I've just shown you there. So some performance analysis scripts that can be put into your system. Of course, it's not just about your system. I've referenced this throughout, the psychological guardrails that need to be put in place. And this is about recognizing on your own internal triggers. So what is it? If you find yourself deviating away from what you should be doing, what's creating that? What's the internal language that you're using telling you to do? Is it fear of missing out? Is it revenge training? Is it overconfidence? You'll know for yourself, but you need to be honest about it. You need to look in a trading mirror, if there is such a thing. Maybe I should send them out to people for Christmas, eh? Give me Mike's gift to the world, trading mirrors. And you can honestly own what it is that you're doing or not doing. That may be getting in the way of a great system giving you good results on a consistent basis. It is really important, and I referenced this very early on, sort of in passing, but it is really important that you recognize your thresholds. I've come with a few new terms recently. Emotional thresholds is one. If you're tired, or if you're tired or unwell, perhaps you should be trading. If you've had a series of losses, perhaps you need to alter your behavior. If you're getting a bit bored, you think, oh, look, I need to get my money to work. Let's just enter a few trades. They may all affect execution, and it's really important to have some situation or some situational analysis in place that says, right, if I move into this state, then now's the time to walk away from my computer screen. Or if I'm in the state and coming to my computer screen, these are the things that I need to do to put me in the right place to start to trade, start to make decisions on open trades. You can also put in some other guardrails that are going to help with maximum daily trades or loss limits, you might say. I mean, I would, again, looking at the very early days when I was teaching, one of the things that I sort of used to ram home was have a maximum number of trades. Don't surpass that. Because let's say 2% loss on every trade becomes a 10% loss if you've got 5 open, potentially. Have what I'm terming pause and reset checkpoints after drawdown events. So if something happens, and I would say equally, if you have a great event, a draw up, if indeed that is a word, I wonder what the reverse is of drawdown. Anyway, yeah, let's just call it draw up. All right, let's just invent a term. But if you don't walk away when there's been a significant event, to take a breath, push the reset button, and then come back again, then that puts you in a dangerous place either way. Either you're upset in some way, shape, or form, and that upset continues because you haven't pressed that reset button, or you've now turned into the trading Superman and wearing your underpants on the outside with a big S on your t-shirt, and you believe you can take on the world and feel the market and all that other nonsense that some people talk. And all of a sudden you're giving back not only what you initially won, but more on top of that. So this pause and reset, and you can articulate these. If you write them down, if you can say, if I've had a loss of more than this or a win of more than this, then I walk away and I don't come back to the market for 30 minutes. It's not rocket science to actually plan. And if you plan it, you're more likely to do it. If you don't plan it, just attend this webinar and think, oh yeah, that's a good point there. I might have a look at that at some stage. Nothing will happen. Nothing will change. And then again, you can sort of have routine plan interruptions. Again, this sort of realigns you to what you should be doing. So step away, recalibrate, return. Is a bit like pause and reset, just put in a different way. But if we look at what those who are really, really successful, those who are professional traders in a professional trading environment, in an institutional environment, they all have these in place. They all have routine pattern interrupts to make sure that they retain their edge and their sharpness. They have maximum daily limits in terms of losses and profits and number of trades they take. They have this. So if it's good enough for them, why shouldn't you develop a little mini plan? Why shouldn't you? So I referenced before market adaptability towards the back end of the session, the educational part anyway. It is possible to adapt to market situations without losing your plan. It's all about having those variations planned as well. So it doesn't necessarily, consistency doesn't mean rigidity. It means that the flexibility that you want to exercise in markets, because you're now at an advanced level, is structured. It's pre-planned. Usually when it's something like this, it means they got some sort of measurement or some sort of parameters in place to say something's changed in the market. We're broken through. We're now not making higher highs. We're now making lower highs, lower lows. As trend changed. Notice that volatility has shot up. Now the European markets have opened. It may be so. One of the market regime indicators is possibly one of the positives of something that we put in to EAs. So let me just see if I can find it quickly to show you what it looks like. Okay, I'm just going to take off some of this nonsense. Okay, let's take off the Monday. Don't tell anybody from the ATA that called the stochastic and stochastic and the RSI a nonsense. Anyway, they'll get very upset with me. Do things like that. So what we've got is different market regimes. So you can see here, we're most definitely in trend up, low volatility. It's not particularly high. Here we're choppy in this bit here. And we're sort of still in, we're trend up, low volatility. Still in low volatility trend, and now we're starting to change. So we've changed into a low volatility downtrend, and then we've sort of moved back into range bound, as you see. So that's what I mean about a market regime, some sort of market regime measure. That was one that we developed to go into EAs. But it's a useful add-on if you want to, if you say this strategy doesn't work well in a low volatility market because you've now got evidence of that, then that's what you do. Or you can say that so here we look at a fake out. So you can say if a fake out happens and it would turn into a high volatility market, the chances of this being good are not that high because you can shoot down here before you got a chance to enter. Whereas if we sort of say, right, okay, let's find a good example. We can sort of say that, hey, look, if we get a breakout and that breakout is associated with a low volatility uptrend, so there's our breakout, there's a good chance of it continuing to the upside, or vice versa, of course. Here we had a retest and then a continuation of that. So that retest was based on choppy. So if it's choppy, you might wait until there's a breach of that low candle and then get in on this one. So market regime is really, really, really useful. So you know what time frame you're looking at, the market regime will change accordingly. And here we are. So we've got a situation here where we've moved into a trend up. We've got a breach with a trend up, and then we can take advantage of that and we get continued confirmation that that's continuing until this point. when it continues no longer. Market regime is key. I'm almost tempted to create an EA which has no price action at all and just trades market regime. It changes, just trades a change in market regime, full stop. Then have some good exits. Anyway, another story for another day. You can look at correlation shifts across assets. Again, at an advanced level, you could look at what gold versus USD is doing. Obviously, they're usually inversely. There's usually an inverse relationship there if they're both moving together. Something odd going on. We can look at things like the Nasdaq and gold together, both expected to move fairly well. We can look at inverse relationship, other inverse relationships like the VIX and the S&P 500. So anything that deviates from what's the norm it should be interesting, and we should be observing for. And there's an idea. Somebody dropped me a line on Discord saying, reminded me of that correlation disparity, let's call it, for some potential panels. So if we're wanting a framework, what I wanted to do is give some practical stuff to walk away with. If we want to have this one term adaptive consistency, we keep our structure, but we observe deviations from what is normal. So any of these, and then look at what parameters will work in that situation, and then we and that helps reconfirm an edge. So we sort of say, right, okay, now we know this strategy works well in this particular market. Let me give you an example. So if we're looking for a mean reversion strategy, such as a Bollinger Band strategy, yeah, this is a new, I'll have to put on another account, a new share CFDs account. Only works if you've got share CFDs on your account. There we go. Lots of green means it could be long. Lots of red means it could be short. So let's check out this. Let's just have a look at it. That's wouldn't be my choice, but it's an interesting bounce. That's an onions pop now. Let's have a look at another one. Let's have a look at what else is doing. S32. Yeah, really nice chart on S32. So there's one for tomorrow morning. How long does that take me to find with that scanner? 2 clicks and you've got a potential trade. Anyway, I've completely forgotten what I was talking about then. Anyway, oh yes, so we're looking to see what happens when there are different situations occurring. So after a while, we're going to get a picture of what's working, what's not working in particular market. I know what I was looking for. Sorry, every now and then I just flip off on another tangent. Let's do this. Let's do this. Let's put some Bollinger Band stuff on here. Okay, Asian session. Usually not as choppy. But if we get a move out in the Asian session, or the back end of the Asian session as we have here, we can get one here until the European session. Quick. Okay, so this is touched the outer Bollinger Band, and I'm going to mean inversion to the middle again. Okay, touch the outer part of the Bollinger Band, mean inversion again. Asian session, nothing happening there. So mean reversion strategies are often quite good in Asian sessions. That was the original point I was trying to make. We need to avoid the trap of strategy hopping, sorry, pretending that's adaptation. So when we're talking, so there are strategies which fit particular market types, but when we're talking adaptation, sorry, we're talking about altering the parameters within a strategy to suit changing market conditions. So how do we turn all these ideas into a live framework before we go and have a look at live markets? Well, thank you very much, Wayne. Define the what. So have your clear strategy logic, and then your rules for entry, exit, and your rules for how you're going to review your trades. So you need processes and systems that allow you to have performance feedback and reflection on what's happening, why, and how you can improve it. And then, okay, so that's all to do with your strategy. In terms of your trader consistency plan, then you have a weekly review template. You have key metrics to track in terms of not your trades, but your behavior. So things like how many times did you stray from plan? How many errors did you make? And have one improvement target per week. And then there's things like MT5 reports, reviews, screenshots, automated trackers, self-review checklists. I've got those coming out my ears. So if I was to sort of encapsulate everything that I've talked about in terms of how do we take this forward practically, this would be it. These three things. Turn your ideas into a live framework which has all component parts to facilitate consistency. Have a consistency plan which focuses on behavioral aspects, and gather around you resources that are going to enable you to do that, to make it easier, quicker. If you can do that, as I said, that's a great example of easier, quicker. Okay. £50 USD is looking interesting on the 4-hour chart, by the way. So let's find a short trade for tomorrow. If there is one potentially. Let's look at Bendigo Bank. There we go. How long did that take to find? Look at a weekly chart for context. So when will I get into this? Well, we look as though we're potentially moved to a support level. Looks as though we could move down here because of that previous price action. Potentially move to the downside of 5.6%, and that took me 25 seconds to find. If you're interested in that, obviously if you're part of my groups in other places, if you're interested in asking questions about how that works, put me online. There's FX scans that do exactly the same thing. There we go. Some of you got my other email addresses, but I'll give you my Go Markets. Okay, and I can sort of help you in terms of what sort of things like this you can put in place. All right, let's have a look at markets now. So you've got a plan for action. What I might do, actually, if you give me a second. Oh, wonderful, wonderfully nice guy. I am going to do something really quite special for you, because I want you to go away and do something with this webinar. Okay, I don't want this to be something you say, oh yeah, well, that's cool. Let's get back to the norm. So I'm going to try and do this to get out of that screen. Try and create your little handout. Okay. Welcome. So make it a little image. Actually, what I might do is I might make a little PDF. Okay, give me a second. Rather than an image, it'll be easier to download. Options, coastline, doom, publish, boom. Okay, so it's going to look something like that. Okay, so I just need a minute just to sort of do this, and where is it? That's not what I was expecting. If it saved it to a different place. Ah. I can't wait now. Right, I'm going to try and put it on. I'm going to try and do it again. We're going to try and set it on desktop so it's easier to find. Give me a second, sorry. I did save it in a different place. Let's put it on desktop. Just do that slide on this. Right, there we go. We should be able to find it now. Right, let's try again. Okay. Right, that should be it. There we go. If you look in there now, you should see it. You're welcome. So it took a little couple of minutes there. Right, anyway, back to the markets. Let's have a look at some market stuff. Okay, let's start with the US 500. So US 500 on a daily chart. This is where markets are doing. This is what markets are doing. We're within striking distance of record highs. Why is this the case? This is the case because of the Fed. 0.71% away from record highs on the S&P 500. Lagging a little bit on the NASDAQ. Sure, I will have a look at that for you. Give me a couple of minutes and we'll just get to look at a Tesla chart. So the Nasdaq's lagging a bit, but a really, really strong bounce off this 10% correction over the last couple of weeks. And again, we're not that far away from record highs, less than 2%. The reason for this is the expectation now that the Fed are likely to cut rates. Let's just see what they're at now. That it dived, and that was part of the reason that the market sold off a little bit. But if we see now we're at 87% chance they're going to cut rates when they meet next week. That's what has driven markets to the upside, undoubtedly. On top of that, there's some retail earnings that have come in that are really quite good. So whichever way you slice it, buyers are back into risk on assets. Let's just have a look at another couple. We can see that because it's risk on, the US dollar has been under a little bit of pressure. So risk on, and we've obviously got the US dollar dropping because of that increased likelihood of the Fed. Now it's the lowest point. If it closes here, it'll be its lowest close since this candle here, back here at the end of October. And of course, because of that, what we're seeing gold looking very chirpy again. Just a little bit of a pause around this 4,200 level, nice round number there. So we're in a little bit of a liquidity zone on gold between these 2 points. So 4,234 it would be the level I'll be looking out for, and then of course that's record highs back there. So definitely risk on. Copper, I did talk copper. Yeah, Monday's live update as we're preaching through this level, which we're here on this candle here. So that was Friday's candle. That was Monday's. Just pulled back a little bit towards the back end of the day. Really strong session today. This big drop with Trump's 50% import tariff on copper into the US. So we've got a really nice potential move to the upside. 2.5% on copper is really quite a big move. That's looking hot to trot right now. We'll look at a 30-minute chart. And this is what's attractive about it right now. Of course, it has to breach this level, but it is giving it a good cracker right now as we speak. You're not going to get a potential More current, worth watching right now chart than that, simply because of that price action that you see right in front of you. Obviously, golden rules apply. It's got a worthwhile absolutely waiting for the candle to close. On any breakout, that's going to be part of the rule. Check in with longer term time frames. Make sure that you've got a. The nice thing is this has got a couple of really nice stop levels, so you can manage risk quite well. And of course, unless it closes above that, potentially with some space, but it drop down again. So it's no means a gimme, and that's why you have to have a plan to trade that, as we've been talking about already. Oil is looking a little bit tricky, and you can see here oil is holding its own above this sort of 57, 72 level. Nice bounce off that. This is 4 years lows. 4 year lows. It looks he's sort of quite stuck in there. There'll be the EIA data tonight. And, let's just have a quick look at Aussie GDP was a bit weak. That might persuade the RBA that all is not actually quite well, despite high inflation and good jobs. Just FYI. I don't think that is going to influence their next meeting, but it might the one after that. Really big data coming out. You can see services PMI data coming well out of Europe. This ADP number, this jobs number, which is a private survey, not going to release reports. It might actually be accurate. We are expecting a drop off in jobs in that ADP report, so that'll be interesting. There should be weekly jobs tomorrow. You see, there's those crude oil inventories. That's going to impact on oil price. There's the weekly jobs coming out of the US tomorrow, but the big one, the big number, is the PCE. So the PCE number on Friday is the big number for this week. Fed's favorite inflation number. There's lots of final revised numbers here. They are not particularly influential. So with the two jobs reports out of the US, the ADP tonight, unemployment tomorrow, but it's going to be, I think it's going to be that PCE. That may determine whether the market starts to price in a January cut as well. While we're here in internet land, let's just have a look at what's happening in to the futures generally. So this is what happened last night. Let's have a look at the futures. You can see here, European futures doing well. Not surprisingly, we've got oil and gold and copper. Copper's flying. Weakness in the USD, strength in the yen. Strength in the yen versus the USD. GB pound looks particularly strong. And the Aussie dollar's not looking half bad either. A little bit of look into what's happening in Europe. So it's a little shy. What happened in the UK? Let's go back to that data. Maybe a number came in a bit stronger than expected. PMI data is really quite strong. A lot stronger than expected. So across the board. Services PMI most definitely in expansion. Nothing there that would flip it over. Very much. Interesting. It looks as though it could be worth checking out a GB pound cross. Really nice move on Bitcoin today. Whichever way you slice it, that's a good move. After this 36% drop, we're now getting a little bit of a bounce. That could be this sort of retracement sort of bounce. So the fact that this has made a new higher high after this retracement is really important. So Bitcoin looking interesting. At this stage, you might look at 93,700 as a level of interest. Yeah. Quick look at a couple we've already looked at. The GB pound being strong, and there's the GB pound versus the USD. Let's just check out that on an hourly chart. Yeah, look, that's a really important breach. How's that sit daily chart? Multi-time frame. This is multi-time frame agreement on the GB pound USD. Looks very strong. Let's just have a look at some of the other GB pound crosses. Strong against everything, 0.5% plus. GB pound Kiwi. Really nice bounce on the daily chart. Engulfing candle. Look at the hourly chart. I think this is strong across the board. But they changed their mind on bit of greed popping in there. Looking for extreme greed. The level on the GB pound Kiwi, which would signify a sentiment change on the hourly chart, would be this 231. The GB pound yen. The only issue with the GB pound yen is I think it's possibly gone. It could get into a bit of choppy territory kicking on around here. So let's just have a quick look. Aussie's quite strong as well. Let's just have a look at Aussie USD. Don't know why it's a slow. So the Aussie USD, really nice sort of measured climb to the upside. Looks as though we're stuck now between underneath 65.84. Looks like an important level. Also, we'll move up to 66. That's not that bad. Staggering. Right. Okay. Got to plant the flag in the chart of the day. I should have just looked at the FX scanner, shouldn't I? Made life a bit easier. Same sort of principle as this. Let's make our chart of the day for FX. Copper's out, if you like, copper's our big picture chart of the day for all the major assets. Let's just check out GB pound Canadian dollar. Quite like that. No, capped upside. Capped upside on the GB pound Canadian dollar about 30 pips. It's a really strong move on the Kiwi. Okay, I quite like this chart. So we've got a potential breach of a key level around about 114.60 with a move up. It looks as though it might hit traffic around this area. See all these wicks here and that soft candle there. So, but that on a 4-hour chart is around about 2 ATR. And if we look here, the ATR is around about 7. That's about 30, 32, 33 pips. There it is. Nice straight candle to the downside. That might be really clean moves in once it's in this range previously. I'm going to make the Aussie Kiwi a chart to watch, chart of the day. But I also keep an eye on the GB pound, see if it's got any strength in it. No. Yeah, that's what I do. In terms of the US, I did promise to have a quick look at a couple of charts, so let's do that. Just put on this. Let's change this to a nice template. Sunday chart, 6 of 1 here. Let's look at Tesla to start with. Really nice bounce in Tesla. Following this significant drop down to around about this down test, this sort of 400 level. Nice bounce then. This feels like traffic to me around about this 430, 440 mark. So that to me isn't compelling right now. Nvidia's not that sort of different. Look at Nvidia. Again, we've got that fairly big drop. Don't look as though we're out of this downwards trend channel yet on Nvidia. And that's been a fairly significant drop, though we have seen some buying come in the last couple of days. That's almost bear market territory. It was kissing it and caressing it, whatever, however you want to frame it. Micron are one that we've sort of been interested in. We think this is very strong fundamentally, but it's probably a little bit early. 255 is a key level to watch to the upside, 200 to the downside. Looks more likely to test to the upside at this stage. Airlines have sort of been interesting, and we have at last. I've been talking airlines for a couple of weeks. Last got a movement on LUV. We talked about this on Monday's session. About a 6 or 7% move potentially on Southwest Airlines. Light has just been, or LITE has just been our chart of the month, but it's finally had a drop off after this, but it does this. So we're watching 323 on LITE, and I also wanted to check in on Carnival, which had a little bit of a weaker day yesterday. I like Carnival. Their earnings actually weren't bad. They are still in a downwards trend channel, but I'm waiting for a move back over the. This to me looks like institutional accumulation, but you were toiling, as I said, on gold last week. But I'd like to see it back over that 200 MA, so a move out of that downwards range over 26.54 could be one worth keeping on your longer term radar. And then a couple for tomorrow. I've had a look at a couple already. S32 with a pick of the bunch from the scanner. There we go. There's S32 rocking and rolling. Very, very good indeed. Let's see if we can find one more. Fisher Paykel, is that FPR? No, Fleet Partners. No, don't like it. It's not technically a bad chart. If you're looking for a long-term hold, there's 4% in that maybe. Some strength in iron. That's Fisher Paykel. A bit of a down day today, so no. So again, this is a one in waiting. The scanner doesn't aim to give you ones that are happening right now. It gives you ones that are setting up. So you can do exactly that and say, right, what would be my potential entry of this? 33.55. Not that. Confused. Oh yeah, Flight Center. Right, Flight Center. I like where this is sitting. Beneath that, you can see it's been a long-term range now since March. It's been in this range between about 1180 and 1380. Looks as though we're about ready to push up to the upside. Last 4 candles have tested that. Keep that as a chart of the day on your radar. And one last one to have a look at, back to the US. Because again, it's been one of my faves over the last while. That's a really nice bounce on Bitcoin, by the way. Let's just. I haven't looked at the last couple of days. This is the ETF. Oh, it's looking great. Okay, so this ETF is an ETF in the US which has rare earths and so-called strategic metals. This is the level to watch out for. I've been talking about this now really since it was down here. Tested this level, retracement, tested this level again. 74 looks great as a potential entry should we breach, and to $80 should it do so. But until it does, it's stuck in this range and could equally come down and perhaps test 67 again. So again, waiting for confirmation of setup that there has been a change in sentiment would be prudent. Anyway, there's some charts of the day. I hope that's interesting and useful. Let me know if there's anything else. Any others? I think I've done most of the ones you asked me to do. Apologies if I didn't. But I can't say anything odd so yeah, we can call that a day, I think. So thank you very, very much, as always, for popping up, for your questions, for your comments, all that sort of stuff. Thank you to you guys cruising around in YouTube land. Thank you very much for that. I will say good night, whether you're on YouTube, good night to you now, and on GoToWebinar, good night to you next.